Hello and welcome to the final session of Real Deals' Tech Innovation Conference. I'm Talia Masiri, editor at Real Deals, and in this session I'm joined by Adrian Astley-Jones, CCO at Intuitus, David Barber, managing partner at FPE Capital, and Duncan Ramsey, partner at ECI. In this session, we'll discuss the impact of improved technology on returns, whether tech tools can aid the exit process, and what tech tools are here to stay in PE. So just to start, hi everyone, thanks for joining me. If you could each just give a quick introduction to yourselves and your firm for the benefit of our speakers. Adrian, would you mind starting us off?
Sure, yes. So hello everyone, I'm the Chief Commercial Officer at Intuitus. We are a specialist technology and digital advisor to private equity solely. We advise a range of clients from lower mid-market through to upper mid-market across both the transactional side of private equity, so buy-side, sell-side diligence, and then in the post-deal value creation space. So we're all about advising private equity, technical and digital environments, and helping them maximize their value through the process.
Great, thanks Adrian, and look forward to hearing your insights as we go on today. David, could you follow please? Hi.
Hi, good afternoon. So FPE Capital is a lower mid-market specialist investor in software and services only. So this is a very relevant subject for us. We've done a lot of work. We only invest in the UK and Ireland in terms of headquartered businesses, but our businesses tend to be very international, and we're helpful in taking those businesses to other markets. Our check size is about 5 to 15 million sterling. We're often unlevered. We're a growth investor, so we're much more about the first phase of growth with the entrepreneur post the entrepreneurial phase, and that's really our specialism. And look forward to talking a bit more about that as we go through.
Great, thanks David, and look forward to hearing your views and kind of some examples of how you've been working with some of your portfolio. And last but not least, Duncan, hi.
Hi everyone. I'm a partner in the commercial team here at ECI. We're a UK mid-market growth-focused fund. We invest in businesses worth up to about 250 million. And tech is a huge theme across our portfolio. Very common. My role in the commercial team splits between doing new platform deals and then partnering with those businesses to drive the value creation agenda over the course of our relationship, which technology is often a key part of.
Great, thank you, Duncan, and look forward to speaking more with you too. So just a quick note to our audience before we start. We do encourage questions, so please send any you have through, and we'll do our best to address these at the end. You can do that via the question mark icon, which should be on the left of your screen. So please do send them through. Okay, so to begin, I'd like to look at tech within portfolio companies. So Duncan and then David, if you could follow, where can improved technology within a portfolio company lead to improved returns?
Yeah, so I think it varies a lot by business model, like where the kind of optimal value creation lever lies. But often step one is investing in the kind of tech machine itself, which I include under that infrastructure, code, people, process. Getting set up for rapid, high quality delivery allows the organisation to then kind of focus on delivering value. So one that Adrian and I worked on together actually is a good example, which is Optimum Technology Group. We're kind of improving that delivery machine, enabled it to quite rapidly deliver commercial value, which in that business was partly supporting the graphic expansion, but also in focusing around customer conversion, because it was a marketplace business. And that business IPO back in February and is worth kind of 800 million today. So that tech piece was a key piece of the story as part of that. And a couple of other examples in the portfolio would be Avantia, where we've done quite a big investment, it's a home insurance business, into a kind of machine learning platform to help them kind of price and make commercial decisions, or Bionic, which is a SME price comparison provider where we've used technology to enable, make the sales team effectively Bionic, and put in place digital customer journeys, once again driving that conversion piece.
Really interesting. So kind of improving tech at different stages in a business, whether that's kind of the outward facing technology or kind of more back office internal systems. Really interesting. And David, what are your views on this?
Yeah, I was going to draw that distinction between the outward facing and the inside bit. So all we do is tech. We're probably a bit more specialized than ECI. So everything's going through a very similar journey and most of our businesses are really in the SaaS and cloud migration space. So there's a tech journey which is adding massive value because you're going from probably an older product to a newer one, a delivery product that was on premise to the cloud. That's a very valuable journey, and clearly achieving that is core to value.
Yeah,
I'll leave that for a second. I mean, there's a lot behind that, and we work with people like Intuitus, who we know very well, on a number of those. And we have a bench of CTOs. We have a CTO group that meets quarterly, and they will swap stories on insourcing, outsourcing, DevOps, where they can get resource from. So there's a whole world behind that. In terms of the internal, we find, being the first investor alongside founders, we're normally picking up businesses that have very little process. So even doing the basic ERP, CRMs, and increasingly, and we've seen this since the pandemic hit, digital lead gen. So with exhibitions, conferences, normal sales channels being very much curtailed, businesses are becoming very, very focused on digital lead gen. And we've got a number of products that we put into businesses around Pardot, HubSpot, a lot of these kind of things for lead gen. And then at the other end of the piece, on the financial metrics, there's some great packages, things like SaaS Optics, etc., which will enable you. And this is really important, because what we're doing is taking immature founder-led businesses and getting them into a position where they're more mature for the middle market, is putting solidity, KPIs, and confidence around that business. And tech is very, very useful for that, because the middle market is pretty data hungry when it does its diligence, and there's real value in presenting that on top of the tech change you've done. There's real value in having a sort of bulletproof set of financial KPIs.
Definitely, yeah. And as you say, kind of assisting with those CRMs and certain platforms help to professionalize the business, and obviously in turn will then drive greater value.
Yeah, and we have product champions in the portfolio for each of those products, who the rest of the portfolio can go to, because otherwise we'd be spending a lot of money on consultants the whole time, and it's nice for them to learn from each other. It's a good way of doing it.
Sure, really interesting. Thanks, David. And Adrian, I guess you're best placed in terms of the advisory side, and how should PE funds, in your view, look to assess whether kind of improved tech can drive value within their portfolio companies?
Yeah, I would agree with what Duncan and David had said, but I'd add to that is, I think it might depend also on which sector the private equity firm is investing in, and therefore how strategic the technology is seen within that organization. So, arguably, I know David does a lot of this in terms of moving software firms from more traditional on-premise environments to SaaS environments. That is quite a complicated, tricky journey that, if you get right, will absolutely drive value, and exit multiples will, everyone can see that in the market at the moment. Very good SaaS platform businesses get fantastic multiples. But I think also, in the more what I would call traditional sectors, so let's say supply chain, manufacturing, industrials, I think there is also a play around understanding how technology can drive change and enable change. And I think the key to that across all sectors actually is, understanding that in terms of the value creation planning that you can do up front, and whether you do that during diligence or whether you do that immediately post-deal, we see a lot more value creation planning happening very, very early on as part of the overall investment thesis. And that's, I think, that's a key part of the overall jigsaw. And we're seeing more firms, and again, Duncan and David, I think, are doing this already. We're seeing more firms bring in specialists, either chief digital officers into the private equity firm, or specialists like David referred to as a panel of CTOs who really understand how to drive value in technology, from get-go, from day one, quite frankly. And if you get that right, it's a powerful mechanism for driving value without a shadow of a doubt. And that goes, that's without even touching on, things like, when we're talking about systems change, product change, how about data? How do you commercialize data? There's so many different things that you could do. And I think one of the big factors is, what can we do in the ownership period? So, if you haven't planned from day one, and let's say you just turn attention to this in the second year of ownership and you've only got 3 years left, well, how much value can you drive in, let's say, 18 months, 2 years before you start business? And technology change can be quite tricky, right? So you need to really think that through, get that right, and make sure your timelines and your timescales really fit to the exit horizon you're looking at.
Definitely. No, it's a good point, and that whole idea of considering value creation from the outset and from right at the start of the journey. But Duncan, now looking at exit, so our session kind of focuses on the last stage of the journey in this session. So what kind of can technological improvements at portfolio level lead to a better return at exit? Is there kind of a direct correlation or kind of cause and effect there?
Yeah, I mean, it's hard to be mathematical about it, of course, but I definitely think that's true. And we've invested a lot behind a lot of our portfolio companies to take them on big tech transformation projects through the course of our investment. And so the likes of the ones that I was talking about before, Avanti is highly differentiated in its market now, because it has this machine learning based capability that even some of the big insurers have not managed to develop. Bionic is recognised by its customers as being the right person to deal with, because they're so much more efficient at kind of converting leads, and similarly ATG was able to, through the kind of, there's a reinvestment process, but the first exit that we had was able to kind of act as a platform for PA when they bolted on a US acquisition. All of those things are enabled by the tech investment that we've made through the course, and if that wasn't there, then the business would definitely be less valuable. Yeah, definitely, really interesting. And David, from your perspective, so where FPE is a tech-specific investor, how do you look to improve these types of businesses to become more profitable in the long run? So obviously, you said you look at growth businesses anyway.
Yeah. I think there's a few different routes here. Some of the tech businesses are sold on EBITDA, and then you've got to, just like Adrian said, you've got to get your investment dip and period right, because A, that's going to depress profitability, and B, no one's going to buy your business if you're in the middle of a tech transformation and it's not working, because they want the proof point. So he's absolutely right, and we've worked with him on a portfolio company. I won't name it. We've sold it quite recently, where we front-ended the work with one of his colleagues. We brought in a CTO, and Adrian's colleagues helped us do that. We put in place a big CapEx spend, and it was done right on time 3 months before we sold the business. And that was core. You can't sell a business in the middle when you're mid-flow on that stuff. Yeah. The second point about profitability is oftentimes we're happy to keep growing the top line and sell businesses on revenue multiples. And increasingly people are happy to buy on that basis, which I think is an Americanism that's come here, and to be honest is welcomed by us, because it's nice to keep that growth going and not pull back a bit. But secondly, the journey to SaaS, I'm sorry if this is a bit sort of centric on what we do, but it's kind of what I know about. The journey on SaaS is a journey, and Adrian will know this, about getting customers to accept that bespoking is actually probably in most cases not required. If you can get people onto a single version of software, there can be some customization at the edges. You reduce your maintenance and your costs and your interventions massively, and your margin goes up. So you do produce a higher gross margin business, and that's where the profitability will come through. And we'll see buyers buying on revenue multiples, but they will always be looking at the gross margin. There'll be a very, very important indicator of what's in there that they can make that business into with another 4 or 5 years of growth. So it's the processes of a highly efficient business. SaaS is about efficiency for everybody, for the user, but also for the software business.
David, I think that, I mean, I totally agree with what you've said there. I think it's also interesting that, the question is, can technology improvements add value at exit? I think the answer to that is undoubtedly yes, but actually the execution can be a critical thing. So I think part of the answer to the question is it can degrade value as well. And that might sound strikingly obvious, but the world is littered with examples of carefully executed technology transformation projects. So I think getting the right team, the right people involved, engaged and motivated, and forming those leaders and those project teams, might be stating what is probably horrifically obvious, but is really, really critical. And I think in some of the, the lower mid-market businesses, as David's already said, they're entrepreneurial. They probably or might not have been through some of those experiences around driving change, and that's where it's critical to realize that and make sure the support's in place. And it's interesting. We see a lot of mandates come across our desk from our clients, and there are, you'd be surprised how many are businesses which are in the middle of a technology transformation. And again, as I'm repeating myself a bit here, but as David said, the key question from our clients is, well, how do we proof point that they're in the middle of this migration or transformation, and they're going to get to the end of that journey without, overspending on CapEx and OpEx or, degrading value? It's a really critical thing to get right, and your timing, I think, is super important on that.
Yeah, definitely. It's all about kind of having all your ducks in a row, in a sense, having all those kind of different bases covered and the right people doing the right things there. David, did you have something to add there, or no? Okay. So now looking at kind of the tech within exit processes. So earlier in the conference today, we've discussed and looked at how technology and tech tools fit into origination, how it fits into the fundraising process. But I guess somewhere where technology isn't perhaps at the forefront is within exits. But Adrian, have you seen any examples of where tech tools can assist deal makers during the exit process, or what would you say? Is it largely just data and databases?
Yeah, I think it's probably at the moment more of the latter, where, and I guess Duncan and David would probably be better placed, or will definitely be better placed to see how they map the market for where their exits might be, whether it's trade, strategic buyers, or private equity. So I think there are those databases, there are those industry portals where you can go and find all of that data. But I think one thing that we have seen is on the whole definitely around tech assets. So either strategic tech software businesses or highly tech enabled assets like a currency trading platform or something like that.
Yeah.
There's more vendor diligence going on, and therefore vendors really looking at the detail of the technology and making sure that's in the best possible position before they actually go to the market and issue an IM and go through the whole process. And part of the technology that's deployed in there could be, the code reviews are very, very much more prevalent today than they were, I think, 3, 4, 5 years ago, where, technology itself and code review tools or methodologies are used to help buyers understand and sellers understand, actually where are the strengths and weaknesses in a code base. So I think there are points of technology, but I don't think there's a magic wand in terms of, hey, here's a system that you can apply or run during an exit process that magics up some extra value.
Yeah, fair enough. No, that makes sense. And Duncan, do you agree with what Adrian's been saying? Kind of how is technology in your view kind of used to exit?
Yeah, I agree completely with what Adrian's saying. I mean, we don't have any kind of exit-focused tool. We've got an AI origination kind of tool, but we don't have an exit tool. I would say, obviously, there's the virtual data rooms and things that have been around for a while, but it's more about lots of little tools that people around the deal will use. So particularly, I think, Adrian touched on kind of code reviews on software assets, but another one that we're seeing more commonly is data and analytics tools. So it might be visualization of a transactional data set in a Tableau file or something that maybe we do ourselves, or maybe it's released by the sell side to some bidders. We've been seeing that type of thing more often.
Yeah, definitely. And anything to add there, David? What are your thoughts on this, and kind of where we've seen technology being used in the rest of the process? Where is it being used at exit?
Yeah, it seems to be creeping in, around the edges in little bits, as everyone said. There's been a lot of talk in the lockdown, hasn't there, about people buying houses without seeing them on the back of virtual tours. I don't think companies, thank goodness for our business, are yet as commoditized as bricks and mortar. And I don't really see that coming in short term. So the corporate finance guys are probably okay for the moment. Data rooms is the obvious place where you can start to see maybe some eyeball technology, looking at where people are spending time, maybe preempting some DD questions. I mean, I've heard about lawyers who've got sort of AI-based DD products where they just scan documents in and it throws out a legal DD report. That's about efficiency, I guess, rather than about changing the process per se. And I think what we'll start to see is huge amounts of increase in data usage around web traffic, who's on your site, who's been looking at your site, and that will start to be a flag for people who might be buyers. You need to know that quite a long time in advance, because certainly small companies, you need to be able to do a bit of courtship rather than just hit them with a digital approach the day you launch your IM, if you're in a sale process. But I would say, and I would say this, wouldn't I, being in the low mid-market, it's a still pretty human business, and selling a company has still got quite a wide variety of outcomes. So you're going to pay for a decent advisor in most cases, I think.
Definitely, yeah. Adrian, the likes of Adrian and other advisors are here to stay. So just, and then kind of on the last point, so I'm interested in looking more broadly at technology as well. So since the pandemic, the importance of technology and its kind of use in business processes has been highlighted and accelerated. But how, to conclude our presentation, I'm interested to hear from each of you in terms of what tech tools you expect to see continue to be used by PE firms going forward. And perhaps we could also talk about where technology may fall short in private equity. Duncan, do you have any views on this?
Yeah, it's kind of interesting, like with the pandemic and things, and this whole kind of digital mode of working. You know, we've been thinking ourselves around what's the future of working for us as a fund. And you know, basically most people want to kind of have almost a 50-50 balance of working from the office versus, you know, working remotely, whether it be from home or whatever. So I think those collaboration tools and all of the kind of cloud-enabled systems, you know, whether it's CRM and other various systems that we use, are going to be pretty important for us moving forward. And then the other piece, and I touched on, and I think Susanna earlier talking about our origination function, how we use AI there, but you know, definitely within that business, there's a lot of opportunity for process improvement, leveraging kind of machine learning basically. So I think that will be a big focus area as well.
Definitely. And would you say that the AI origination tools have been used more so, or has there been more of a reliance on that kind of tool since the pandemic, where we're not actually able to go out and visit businesses in person?
Yeah, for us, we've used them a lot more.
Great.
I mean, we've done 3 deals kind of through the course of this, where the vast majority of the interactions have been virtual.
Really interesting. Okay, thanks, Duncan. And David, what are your views here? What tools are here to stay? What has been the most important for FPE?
Well, I think there's been a lot of innovation in the origination side. A lot of tools out there which are more and more powerful and more affordable. So we use those, and I think that's pretty standard in the market. We're also doing a lot of digital lead gen in terms of origination. We're finding people responding well to that. So your online presence is really important. It's the shop window. An interesting one that I don't know what the other guys think about this, but you know, we've seen a couple of portfolio management tools. So they strike me as being a little bit impersonal. So this is where you say to your portfolio companies, okay, everything you report is going to go through this portal. We might even be sending you, you know, messages back through it. I immediately recoiled and thought, actually, if I'm running a business, I don't particularly want to be managed through some sort of portal. But there are a couple of people with tools like that. There are benefits to having all the information from portfolios inputted in a standard way, so they're not save them time, so they're not giving you information every time. You need a couple of numbers, but I think some of them go a little bit too far. Our end of the market for sure is still a relationship business. Dare I say it, the people we meet are entrepreneurs and founders who they start with, should we say, a slightly suspicious view of private equity. I think we have to work really hard to get through that. And if I said, by the way, we'll run our operation in relationship with you through a portal, I think they might find that a bit of a cold bath. But
yeah, I guess it can be a bit impersonal. that way. I guess when they go into partnership with a private equity firm, they're expecting partners or deal kind of team to be more involved and to speak to them directly.
Yeah, but things will evolve. I mean, once you start putting financial data in, it becomes a channel, I guess. Maybe it's no more impersonal than email if you make it work. I think it probably needs a bit of thought before it gets implemented. But for some bigger people who have multi-strategy funds and lots of things, portfolio companies, maybe it's useful. For us, we're much more personal in the way we deal with people.
Yeah. Do you think it could work for GPLP communications though? Perhaps how you speak with your investors and kind of putting out.
we already use a portal of that sort, because with the LPs, you're often dealing with an accounts team and cash management, where, to be honest, they would prefer that. They're looking for efficiency rather than, and you can have a separate line to your key contact at that LP. And I think there's already quite a lot of that goes on in the market. That's a more transactional relationship once you've got the fund up and running, and then there's a relationship bit which is separate to that.
Yeah. And Duncan, do you have a view on that, on this kind of portfolio company portals and whether they could work?
Yeah, I think there's different levels of it. So we do have we used to just collect spreadsheets, but we do now have a kind of place for people to input that information, which, similar to what you're talking about, David, with LPs, just kind of makes life easier. It's not our primary contact with them, but it's just a bit easier than us sending us a spreadsheet, and then it just tidies things up basically. So we do use that to an extent.
Yeah.
Sure, fair enough. And Adrian, what are your views on kind of tech tools used in PE? What would you say is most useful for PE firms across the industry?
Well, I mean, I'm touching on David and Duncan's point there. I think we have seen some of the larger firms develop sort of portfolio management portals, if you want to call it that, and bespoke platforms for origination. If you would ask me how successful they are, personally, I don't know, but there's been a little bit of that. But I would agree with David, definitely, which is, I think there is a human and personal element within private equity and deal doing per se, and that, I think, involves the whole ecosystem of advisors, partners, so on and so forth. And although over the last 12 months or so, we've all managed to do things remotely, and we've been doing all our diligence remotely, I think there is still an element that you simply can't pick up on if you're not in the room. And you can use technology to get around some of that, Zoom calls and data points, and we've got some benchmarking tools that we use and so on and so forth. But I think definitely in the the lower mid-market, the mid-market, personally, and maybe I'm a bit old-fashioned here, I think there isn't a replacement for seeing the whites of people's eyes and meeting and developing a relationship. And technology can play a part in all of that, but it's a supporting part. I don't think it's the front and central part, personally.
Yeah, definitely. I guess it's still a relationships business, a people's business. And I think if this year has taught us anything, we can't beat in-person meetings and being in front of colleagues and clients. And then at the moment, there aren't any questions from the audience. So I've just got another for you all in terms of, so we've spoke about where technology is useful, but where does it fall short? Where is there still kind of a way to go in terms of technology used? David, have you got any thoughts on this?
I think on origination, you can still get richer and deeper information on companies. I mean, the UK is not bad, but I think there will be people, and there are people trying to add more depth to that, shareholder data, etc. And I think that's becoming more transparent because of various regulatory requirements. And I guess staying on top of the growth of, Companies House is a lagging indicator. 9 months after the year, and you get some numbers. In many cases, abbreviated for our end of the market. They're smaller companies. So there are some quite clever tools out there about how you approximate the growth of a business around headcount or around web traffic. And I think that will be where we will look for more early warning around high growth businesses and the opportunity to get into them. It feels quite early stage at the moment. Maybe individually, the wallet size for firms like us isn't huge, but in aggregate, it could be quite a big market opportunity, and I think there'll be some more work done on that, and predictive analytics around who's going to. The whole data analytics space is very obsessed with predictive analytics at the moment, in whatever format. So why shouldn't that come into our market? And I can see, we've all just said it's a very human business, but 10 years ago, none of us would have thought anyone would be buying, £2 million houses without walking around them, but it's happening. And it's possible that some very small companies, more sort of bolt-on type businesses might be transacted almost automatically. I mean,
really interesting.
In due course.
Yeah, fair enough. And Duncan, what are your views? Where is the industry headed? What can be improved upon in terms of technology usage?
Yeah, I think I kind of concur with David as well. Like the more data we can kind of get our hands on to understand things, and help us triage is really valuable. We do quite a lot of work with people that kind of look into those digital footprints and kind of read those tea leaves to help us both understand if something's attractive, but also to have kind of good topics, meaty topics to discuss with the management team to start to kind of build the relationship. So for me, it's a really interesting area.
Yeah, definitely. Thanks, Duncan. And Adrian, what about you? Where do you see the industry going? And is there any opportunity for more tech to be implemented in businesses like yours?
Yeah, I mean, I think on a general trend, we're still, everybody is still on the sort of cusp of, Internet of Things, AI, big data, and what does that actually mean to businesses, and how do you go about implementing it, and so on and so forth. So I still think there's a lot of headroom in everybody understanding what those technologies are and how you can leverage value out of them, for sure. And that sort of comes back to state of where you are in the investment life cycle, ownership period, and whether you're prepared to, how much risk you're prepared to take on. So, for example, if you've got a bunch of really useful data, then how do you get that into a meaningful position and state? And could you use that to commercialize something that pivots the business in a different direction, that maybe enters a new market sector for you? And those are arguably bigger decisions, which need some investment, which might potentially come with slightly more risk. So again, goes back to where are you in the life cycle? How much risk do you want to take, or is it actually better to stick with the core fundamentals of the business and focus on those areas? But to summarize, I think Internet of Things, IoT, all of these things we're at the tip of those, definitely.
Yeah, definitely. So I guess we've come a long way, and the industry's come a long way in terms of its integration of tech tools, but there is still some way to go. A lot of potential opportunities and new avenues to be explored going forward. Perfect. Okay, so I think that brings us to the end of the session and the end of our tech conference. Panelists, thank you so much for joining me, and thank you for sharing your insights. And I'd also like to make a quick thank you to all of our sponsors and to our events and logistics team as well for making this possible today. But for now, thank you so much for joining me, and hopefully speak to you all soon.